Investing in real estate is great. There are a lot of things that are good about it, leverage and stability and just being able to create passive income or semi-passive income. But one of the things I really like about real estate are the tax benefits. When we do real estate investment, sometimes we can just get tax-free income for something like 20 to 27 years. So that's great. If you want to learn more about it, stay tuned for this episode of Real Estate Investories. Howdy everyone, welcome back. It's Yochanan from Real Estate Investories, and today we are going to talk about investment properties and tax benefits that are applied to that. So let's start with a couple of stories that happened to a friend of mine and a client of mine. Let's start with a friend. They always wanted to do flips. They've seen all those HD TV shows, flips look super sexy, and they bought a house that wasn't in the best of shapes, which is great because you can do some value add. And they've done some renovation, and the renovation became a bit larger. Sure thing. They went to the selling phase, they sold it, paid everything, and they made something like 15 grand. Now, 15 grand ain't a ton of money, but it's not a low amount of money. But one thing they didn't really factor in are the taxes. They didn't plan it correctly, and they had to pay income gains on the entire thing that ate a lot of their gains. They were in a higher tax bracket because they're working on the tech company. So when you pay something like 35% to 40%, whatever the case may be, on 15 grand, you don't have a lot of juice left, and it wasn't really worth all the effort. Another story that I have, and this one is kind of, this one pains me personally because it's a client of mine. So this client of mine, he bought a property with me, and he's calling me up and he's like, hey, I really liked the first time we did it. Let's do it again. I sold my property in Dallas and I'm going to buy another one with you. And the first thing I'm like, hey, did you sell it or are you planning to sell it? And he told me, I sold it. And I'm like, okay, did you do the 1031 exchange? And he was like, the what now? Long story short, he was misguided. His realtor told him that he can sell the property and roll the taxes, but it's not true unless you do several actions. So I'm going to talk about those type of actions in this video. And unfortunately, my client had to pay capital gains on the gains that he had on this property instead of rolling them into the next investment. And that was really unfortunate. So let's start with a deep dive. First thing that we want to talk about are deductions. Now, I'm not going to repeat everything I said in the primary residence tax video thing. I hope it's here. But I'm going to talk about the other thing. So just to recap what we spoke about in prime res, you can deduct your mortgage interest, you can deduct your property taxes, but then with investment properties, we have other deductions. First deduction is capital improvements. So we bought this house and it's kind of ugly, but it's good because we can do some value add. And we go into the house and we are renovating the bathroom and we are replacing the kitchen. We're spending a lot of money on it. However, there's a trick here. We can take the capital improvements that we've made with the house, and then we can deduct it over time. We can take the new fridge we bought and deduct it over time. Basically, we can take the improvements that we're doing to the house and deduct it against the income that we're getting from the rent. So that's another thing that is great about real estate investments, capital improvements. Another thing are expenses. So we bought a plumber to fix a leak. We had to bring an electrician to do something with a GFCI. All of those visits are expensive. We can just take those expenses and deduct them with the income. Another thing that is really nice is trips. So if our property is located in another state, flying there in order to look at the property, and we can deduct the flight, accommodation, and even restaurants. If you are buying in Austin, you can come visit me, have some fun, and deduct it. But seriously, you can fly to look at your property and deduct the expenses, and this can be kind of a nice trick to do. What else? So depreciation, that's pretty much the biggest thing with real estate investments. So per the IRS, when we buy a property, it's basically depreciating into zero. That's kind of reversed in what we've seen with real estate, but that's how taxes work. So let's say that we bought a house for $500,000. Then over the course of 27 and a half years, this house is being depreciated until it reaches zero. It means that during this time, we can take a lot of the income that we're gaining and deduct it with the depreciation. So when we account for everything, depreciation and expenses and interest and property taxes, typically real estate income is going to be tax-free for, well, the immediate or foreseeable future, unless you buy it in cash. It's important to note that when we are deducting depreciation, there's a depreciation recapture tax, meaning that if we bought a property for 500 grand and we did deductions of 200 grand, when we sell the property, the deductions are going to be taxable. However, that's where the trick comes with 1031 exchange. What we can do, we can sell the property and take everything and roll it over to another property, and I'll talk about it in a minute. It's also important to know that with depreciation, you have a reset if somebody inherits the property. Meaning that if I bought a 500 grand house and I depreciate it into zero per the IRS code, if somebody inherits the property and sell it, they do not owe depreciation recapture tax. So that's a big tax benefit that we should be familiar with. Last thing I want to talk about are capital gains. So unlike homestead, in which we can get full exemption from capital gains up to a certain threshold, with investment properties, we don't have a capital gain exemption. Meaning that if we bought a property for 500 grand and it appreciated to 700 grand, that's great for us. But if we sell it, we will have to pay taxes on those gains. In order to avoid from paying taxes, what we can do legally is to do 1031 exchange. I'm going to have a whole separate video to talk about 1031 exchange, but long story short, we can sell the property, take the proceeds and invest it in another property. When we do that, we do not owe any money to the taxman for the capital gains. So it's really, really important to know those type of things before you sell the property. The story about my client, that's exactly what hit them. They sold the property without doing the 1031 exchange and they had to pay taxes on everything. So what are the takeaways from this session? The first takeaway is to hit the like button. I'm sorry, I have to do that. But please, hit the like button, do a subscribe. I don't know, whatever. Help me with the YouTube algorithm, guys. But more seriously, what are the takeaways that we have from this session? So first, expense tracking is key. You're going to have a bunch of expenses when you own real estate. You're going to bring the electrician and you're going to change the HVAC and you're going to do a bunch of things. You should track those expenses. A couple of things that you can do in order to do it well. You can have a separate bank account. You can have a dedicated credit card for your real estate endeavors. This way, it will be so much easier to track down the road. You know how it's like. Nobody tracks it during the year. So do that. Will save you a bunch of hassle. Myself, when I collect rent, I use a dedicated account that I don't use for anything else. When I buy something for my real estate portfolio, I do it with a specific credit card. This way, it saves me a lot of hassle when I need to submit my taxes. Another key takeaway is the double dip effect. What do I mean by that? Capital gains. So if we buy a property and we put money into capital gains, we typically gain equity. If we have done our renovation well, typically we will get more equity than what we pay for. So what I mean by that, I spent 20 grand to renovate the property, but I'm gaining 40 grand in value. That's the type of renovation that you should get into. However, there's another thing that happens here. We can take those 20 grand and we can deduct income. Basically, we can, instead of paying taxes on everything, we can take it and get another benefit. So effectively, we are paying something like 2/3 of the money. So use capital gains in order to gain equity and save some taxes. Another takeaway is depreciation. Depreciation is just the magic in US-based real estate. Depreciating the asset will save you so much taxes, it's not even funny. Typically, we see that real estate can be kind of tax-free for like 20 years or so, 27 even. So do it well, and make sure that if you sell the property, unless you just want to liquefy and get out, do a 1031 exchange. Do not sell your investment property and buy another investment property without doing 1031 exchange. It's going to be detrimental to your gains. So it's really, really important to do it in the right order. And the right order is starting the 1031 before you sell the property. Once you got into contract, it's a bit late. It's also really important to factor the right taxation when you are flipping a property. If you're going to do a flip project, you want to make sure that you factor the right taxes. If you own real estate for under a year, you are going to pay ordinary income tax on your gains. So what I like to do, me personally, I don't really like to flip and sell immediately. I like to flip and hold. In my region in Austin, we see like nice appreciation rates, and I think the region has more room to grow. So I would rather to flip, hold, sell later. I wouldn't want to pay ordinary income on my gains for my hard-earned money from the flip. So those are the main takeaways that we had about taxes for investment properties. So if this video was beneficial for you, please drop a like, subscribe to the channel, follow us on social media, and comment down below what are the next topics that we should discuss. I'll see you on the next one.